Always trying to keep the human emotions out. By the way, if you've got a pulse, you've got a bias. Come into a conversation expressing your biases. So we're always trying to become self-aware of those.
Contrarian portfolio manager John Montgomery on where his quantitative models are telling him to invest and avoid.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. Contrarian value investors are few and far between because the combination is a difficult discipline to follow. Contrarians are by definition going against the crowd, and value investing has been out of favor for well over a decade as growth stocks, large cap tech ones in particular, have trounced value. So we are delighted to welcome back one of our earliest guests who proudly wears the contrarian label and established his reputation as a small cap value manager. He is John Montgomery, who first appeared on WealthTrack in 2006. John is the founder, CEO, and co-portfolio manager of Bridgeway Capital Management, which he launched in 1993. An engineer by training, Montgomery uses computer models and quantitative methods to pick stocks. He oversees 12 different strategies, including small cap, international, and one relatively new long-short strategy. His flagship Bridgeway Small Cap Value Fund has earned a silver medalist rating from Morningstar for its sound investment process and strong management, as well as its sizable cost advantage over competitors. Bridgeway has another distinction. From the beginning, it has given half of its profits to charity every year, charities the employees choose. Since Montgomery has not been on WealthTrack since 2009, I asked him to give us a refresher course on Bridgeway's investment objectives and methodologies.
At the highest level, we seek to have superior above-market risk-adjusted returns. That's true of every strategy that we have. From our prior conversation in 2009, we were U.S. investors in two categories. Omni, which gives you an exposure to an entire asset class, and Select, which typically means a lower number of strategies with higher exposure to factors that we want. Over the years since then, we've done quite a bit of research on portfolio construction. Research is what I love with my engineering background and with the people that we've hired on at Bridgeway. And 6 years ago, we hired some new people led by Jacob Bajorny on the international and absolute return or long-short side of the house. So we've continued to evolve at Bridgeway, and I like to say we are always looking to hire people brighter, more experienced, and with some firepower more than myself. My job is to give them all the energy and structure and culture of a great company, and then make sure I get out of their way to do a great job.
So are you evolving because the markets have, or are there new opportunities that are presenting themselves that weren't available, let's say, or just weren't interesting, 30 years ago?
There's some that are more available to us. For example, previously we only invested in the US. We came to market with a global opportunities strategy last year. I'm very excited about it. That opens up another 5,000 or so stocks. And the larger universe you have, the more opportunities that you have. Some of the industry has come our way in some places. For example, when we started out, you heard of some people paying 12 cents a share for commissions, and 3 cents was cheap, and we were doing it at a penny a share, and the industry has come our way. It's become much more efficient with technology. So yes, the market of investing has changed some around us, but we still look at data over decades and decades. I still study the Great Depression, for example. Mm-hmm. How does the current environment with tariffs and the threat of inflation compare to earlier periods in history?
That sounds very macro. Explain how you use that information and apply it with your quantitative analysis, your quantitative models?
It's more on the risk side. So what we're not doing is classic top-down idea, the economy overall, what that means for different sectors, for different countries, and then going and investing in those. We're looking at data over long periods of time to come to conclusions about how stocks work and different exposures that we want to have. For example, on the new international side, we have a structure of intangible capital intensity. This is an area of research that we spent a couple of years on, published 3 peer-reviewed articles on, and gives us a tweak on our overall structure for the factors that we believe in: quality, value, and sentiment. And then there's some factors that we think we don't want exposure to. So among the value factors, book to market, for example, is one you need to be careful of for technical reasons. Size is something that is maybe good for the long term, but short-term performance relative to the market, that can lead to more volatility. So you need to know what you're investing in and why. So we have different strategies to do different things within a portfolio.
At one point early on, when I knew you a long time ago, I would describe you as a stock picker, and you're saying, no, really don't describe me that way, because you're mentioning factors, different qualities, factors that these companies might fit into that you either want to be part of or you don't.
I like to say we buy groups of companies.
Okay.
That have certain characteristics that we believe are favorable in the long term. You mentioned at the beginning, value is one of those. It's not the only one, and so we have diversifying factors, and diversification is your friend by way of constraints, things that you want exposures to and not. So in our international long-short strategies, for example, we're specifically making sure we don't have significant country exposures, significant sector exposures, exposure to size for bias, since you're matching up the long and the short. So the construction of a long-short strategy is a bit different than if it's just on the long side itself, where obviously you have complete exposure to industries and sectors. And in that case, you're trying to get not too far away from the underlying market benchmark that we would be compared to.
So this is a very disciplined approach. Your human emotions are not involved in this. You're doing it strictly by your quantitative approach. You're
always trying to keep the human emotions out. By the way, if you've got a pulse, you've got a bias. That's one of the things on our investment team we like to say is come into a conversation expressing your biases. So we're always trying to become self-aware of those. We study behavioral finance.
So you have a thesis that there's a perfect storm that is going to create higher inflation. Will you explain that thesis and how you're applying that to your portfolios?
So one, confessed bias, I'm a big believer in free trade. Number 2 is that I'm a big believer in balancing an understanding of stock market risks, the short-term risk of the stock market, with the short-term risks of fixed income. So everybody knows the risks of the stock market. If you lived through April of this year, you experienced some big, reminded how fast and far the market can drop, how painful that can be. You don't want to have money in the stock market that you might need next quarter or next year, or maybe even for at least the next few years. So that's the risk of the stock market. What's the risk of fixed income? People do not have an appreciation for how risky fixed income is. And I don't just mean long-term bonds, also even short-term bonds. So the big enemy in fixed income is inflation. So let me give you an example, and I'll tell you what I understand to be the perfect storm of inflation. Number 1, tariffs. Number 2, other countries selling our treasury securities and driving up yields, which has a negative impact on prices. And number 3 is, and this is the big one, the really huge one that I've been thinking about here for, at least a half dozen years, but it's gotten more and more and more. The spring is being wound tighter and tighter, and that is the U.S. debt per GDP is the way we measure it. So let me take those three things in reverse order. What about the U.S. debt? If you look at the entire history of our country, 2 centuries of data, and look at debt per GDP, national debt per GDP, there were 4 peaks. The first one was the Civil War. The second one was World War I. The third one was World War II, and that was a really big one. It took a lot of money to fund that war, and quite a bit of time to get out of the debt that we took on there. Number 4 was the pandemic, 2020 and following. So 2020, depending on how you measure it, was the all-time peak, or roughly tied with World War II. And it's come down ever so slightly since then. So in round terms, we're near an all-time high of debt divided by GDP in this country. That is a big problem. So debt's a problem for an individual, for a company, for a country as well. And historically, there's only ever been one way of getting ourselves out of a big debt. You'd like to think that you conserve money and you pay down the debt.
Right.
Even with the actions that have taken place so far under the new second Trump administration, there's no chance that we're going to make a big impact on paying that down.
Costs.
It's too much of our expenditures are, quote, fixed. The poster child of that is World War II. So consider this. If you take T-bills, so this is the risk-free rate, we call it.
Right.
That's another conversation. P.S.
Yes.
They're not risk-free from a couple of standpoints. Credit, maybe not AAA right now, but more importantly is inflation risk. If you had $10,000 in 1940, and you invested it in T-bills with interest reinvested over the next decade, the decade of the 40s, the purchase power of that fixed income declined 41%.
So what happened in the 1940s? Was inflation very high?
World War II happened. That was the major event that ran up the debt. Inflation was at a very high level, and you can't spend pre-inflation dollars. That's the problem. You only need to look at this after inflation and its decline of 41%. If the stock market drops 41%, everybody is talking about it. If it happens in fixed income and it's over a decade, you wake up, you get your account statement, it's a tiny bit higher than last month and the next month. It never goes down in nominal terms, but what it can buy is plummeting for some of those years. And that's a big problem for anybody who's dependent or overly dependent on fixed income. I like to think of fixed income as a great insurance policy in the short term against the stock market going down, but it has its own risks. So the U.S. debt, the only way we get out of too much debt is by inflating our way out. And so that there's tremendous pressure on inflation from the level of debt that we have.
What about productivity? What about growing your way out? What about AI, just being an incredible producer of productivity?
Big help. But if you look to our even recent experience, the last time we balanced a budget in this country was under President Clinton. That's been quite a while. I don't see it happening under the current or, frankly, anybody that I look at. We just don't have the willpower and discipline and people saving at the individual company and country levels. So debt is a significant problem. Other countries selling our debt. So there are a number of countries that are not real happy with us right now. And if trade goes down, then the need for them to purchase our securities, our treasury debt goes down. So that lends to an increase in interest rates. The increase of interest rates means higher borrowing costs for individuals and companies, and you're right back to inflation. So in reverse order, the national debt's a big problem. Other countries, which, by the way, other countries own 30% of our national debt. So if they start dumping it, you will see yields go up. And then the first one, and I like to think of this as the match that lights the tinderbox, is tariffs. So in economics 101, when you put on tariffs, other countries naturally retaliate. That means costs go up for companies, for individuals. And there's a little bit of a lag in that. So we haven't seen that coming yet with some of the tariffs that have been, some of those have been put on hold and for negotiations. But there's no scenario based on what President Trump has said about tariffs. He believes it's a beautiful world. I believe him when he says it, and I believe we're going to have it. And I believe that inflation is a result of that. So 3 reasons that's a perfect storm why we would see inflation. And fixed income can be decimated by it. There's one other key aspect of that. What happens when there is inflation? If you're a company, you raise prices. If you're an owner of the company or a stockholder in the company, it means you take part, you get the advantage of those increasing prices. What happens if you're a bondholder? You don't take part in that. It's called fixed income for a reason. That payment is fixed in nominal terms and it never goes up. Bridgeway doesn't have any bond funds, by the way. So, so this is, you could say, not my area of expertise, but I study the heck out of the data. I have personal, personal retirement portfolio myself. I'm a stocks for the long-term guy, which means my asset allocation is 90% stocks, diversified within that, and historically 10% fixed income. And because of this risk, I've replaced my fixed income 10% portion with the global opportunities strategy that you mentioned before, because it's designed not to move in the same direction as the stock market. Some people call that market neutral. And also, in how I've been using it as a replacement for fixed income, because it's not correlated with the direction of interest rates nor inflation as well.
Okay. So is this a permanent no fixed income position that you're taking?
Well, again, up until recently, I owned some fixed income, and I would still, by way of diversification, I think it's a great insurance policy against stock market drops. That's what I think it really is. And I own house insurance. There's nothing wrong with owning insurance, and fixed income can be fair for that.
You think that inflation is going to be a problem for a while, and therefore, for one investment for a long-term diversified portfolio, since you can't recommend your own funds, what would you have us, what's a good alternative?
I think a good alternative is Treasury inflation protected securities. You can get them through mutual funds. I like the direct ones that you can go to Treasury.
Direct.gov.
Yes, as another place. And the thing that's nice about that is there's actually no expenses on it, but also you can choose a particular year. You can do what's called laddering. So you can have some that become due in 3 years when you need it, in 4 years, in 5 years. As long as you think the U.S. government is still around, which I do, then you're guaranteed a real return. So right now, 2-ish% above inflation. If inflation goes back above 10%, which, by the way, I've seen in my lifetime, remember it well, my first mortgage rate was 13% fixed rate, and I thought I was lucky to get it. So this is a guaranteed 2% above, 2-ish% above inflation. That's a good trade-off on the fixed income and lower risk as we classically measure it into the spectrum. I'm not predicting for sure inflation, but regardless of whether it happens or not, it's a risk, and it's a much higher risk than in normal circumstances. So people should be thinking about that.
And John, you have been traditionally a small cap value shop. You're an active manager, and in a time when, number one, everybody seems to be going to indexing, to passive strategies, and also large cap has just trounced small cap, and growth has trounced value. So, you consider yourself to be a contrarian, and there's the proof. Why do you consider yourself to be a contrarian? And also, what are the advantages to being a smaller money manager that is in these three very, contrarian areas?
So let's take those one at a time. What does it mean to be a contrarian? So it's a cycle of what we call fear and greed. So market goes up, greed, you wish you had more. Market goes down, you wish you had less. That causes you to be buying high and selling low. Buy low, sell high, not the other way around. That is a contrarian view, and human nature is such that it's very difficult to do that. As a matter of fact, so much so that to me, probably the single highest value add of a financial advisor is to keep people from making the wrong decision at the wrong time. Like, I think that that is a serious value add for, honestly, the vast majority of people. I'm a contrarian. I am wringing my hands when everybody else is dancing in the streets. And when we have a month like April where things are down, personally, I'm like, oh my gosh, this is a fire sale. This is great. So small in value has been so far out of favor in the last decade, and especially since 2018, and it has been relentless. So we've got some research on this on our website, the bottom line of which, if small in value stocks doubled in price today, doubled, and the S&P 500 stayed exactly the same, we would only be back in line by some measures of valuation with small in value with normal history. It wouldn't even be expensive. It would just be like, oh, well, we're back in range now. I also am a believer in having a target asset allocation and rebalancing back to target. That forces you to be a contrarian. It means whatever is done great, you're always harvesting a little bit from, and whatever has been really out of favor, you're investing back in. And if you get in the habit of that, that can be a very powerful investment tool over years and decades. So we believe there are a number of factors. We put them in three categories of valuation, which we've talked about, but also quality and sentiment that are diversifying between those factors themselves. And if you give exposure to those in efficient ways, and an index fund's not going to give you that efficient way. I'll give you just one quick example. We've done a lot of research on intangible capital intensity, and we think that it gives you insights into how to balance these three in a portfolio. And we think that's a value-added activity for our strategies, and the result of hard research over years. We incorporated that into our process, especially on the international side. That's just an example of one way you can add value on the active side. The smaller side is another aspect, and this is, it's not unique to Bridgeway, but it's true of smaller shops with very bright, experienced people, which I would say we are definitely one. And that is the advantage. We can deliver, and smaller shops like Bridgeway can deliver what large shops cannot in several ways that are all related. One is that we have a broader universe of stocks to be able to look at and get meaningful positions in. Number two, we can invest in less efficient parts of markets. And number three, we have the ability to have strong flexibility with respect to trading. Now, all three of those are related. So I love that we're small. I think it's great. I think it's good for our investors. And the combination of those three is something that's not frequently talked about. And of course, there's a reason it's not frequently talked about, because it's mostly the big shops that are talking.
John Montgomery, thank you so much for coming on Wealth Track again after all these years. It's really a pleasure to have you and get an update on what's going on at Bridgeway.
Thank you so much, Consuelo. It's been an honor to be with you. I look forward to doing it again some years down the road.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is think like a contrarian and consider small company stocks. As we just discussed, small caps have lagged large cap stocks for a number of years. According to a recent report by Morningstar, they are the most undervalued sector by capitalization. Morningstar recently came out with recommendations for small cap ETFs that have earned their gold medalist ratings. They are a mix of value and growth, active and passive. The two actively managed ones are Dimensional US Small Cap and Dimensional US Targeted Value. The rest are passive index-based, the SPDR Portfolio S&P 600 Small Cap ETF, and 3 Vanguard Index ETFs, including its Vanguard Small Cap ETF, Vanguard Growth ETF, and Vanguard Small Cap Value ETF. Now, from a valuation point alone, small caps are worth considering. And from a diversification perspective, most investors are probably small cap light in their portfolios. Well, next week, The Essence of Investing, an exclusive interview with financial legend Charlie Ellis on his new book, Rethinking Investing, a very short guide to very long-term investing. Please follow us on Facebook, X, and our YouTube channel. Thank you so much for watching. As you enjoy the Memorial Day weekend, take a moment to honor the servicemen and women who gave their lives to defend our freedom. Make the week ahead a healthy, profitable, and productive one.